What are the current updates about inflation, technology, and finance? Does Charles Thomas Munger have different views about these things? Our last few videos feature many influential business people and financial advisors. It is interesting to learn more from these people. They might have different views about the issues concerning our economy, but they all make sense. Today's video is inspired by Charles Thomas Munger, an American billionaire, investor, businessman, former real estate attorney, and Berkshire Hathaway's vice chairman. Take advantage of this topic if you want to know how he sees inflation, the future of technology, and finance. We will be talking about 7 points that he discussed. Number 1. Inflation is with us in an episodic way.
What makes life interesting is we don't know how it's going to work out. I think we do know we're flirting with serious trouble.
Charles Thomas Munger was asked about inflation and his view, which always has his belief. Many international investors are most worried about inflation and impulsive central bank interest rate increases. Still, Charles Thomas Munger, 98, is not particularly concerned. He claimed that although he is constantly aware of it, it doesn't keep him from working. He is 98, 12 years old, and has lived through significant inflation. He wants to survive inflation. He has experienced much of it already. That does not deter him. Inflation is always with us in an episodic way, according to Munger. That is what modernity brings about. He therefore thought that someday all currency in the world would become worthless. Munger admitted, however, that increases in interest rates would have a major effect on stock prices and company values. But despite the recent American stock market drop, his perspective has remained largely unaffected. He claims that the stock market constantly experiences ups and downs. He also clarified that the troubles before will be different in the future, and what he means here is inflation. Number 2. He does not believe in diversification.
You don't need all this damn diversification. That's plenty of it. You're lucky if you've got 4 good assets. I think the finance professors and that sell the idea that perfect diversification is professional investment. If you're trying to do better than average, you're lucky if you have 4 things to buy. And to ask for 20 is really asking for egg in your beer.
From this very quote, Charles Munger is not a fan of diversification. Charlie Munger, trades, portfolio, is fond of claiming that he only owns a small number of stocks. He has some of his money managed by Lai Lu, who operates Himalaya Capital, a value investing-focused fund concentrating on Chinese equities. He owns shares of Berkshire Hathaway, the Daily Journal, Costco, and Berkshire Hathaway. Munger disagrees that the main objective for investors should be diversity. Munger explained why he thinks diversifying is overrated in a historical tale at the Daily Journal's annual shareholder meeting in 2019. Broad diversification is incompatible with outperforming the market. Munger started off by stating that diversification can be advantageous for people who are merely attempting to match the market average. Owning an index fund is based on this fundamental principle: optimal diversification across a basket of equities that will provide you with annual returns that are on average. You gain 10% if the market increases by 10% in a year, and you lose 10% if it decreases by 10%. Those who believe they should be entitled to greater than average returns solely because they have broadly diversified portfolios are in Munger's crosshairs, especially money managers. He bluntly stated during the conference that an idiot could diversify a portfolio. Finding the uncommon chances that arise when the stocks you own perform higher than normal is the key to success. As public markets are rather efficient, and there are probably just a few such companies that fall into your own area of expertise, these opportunities will inevitably be few and far between. Number 3. Investing in stocks can be challenging.
Well, if you're going to invest in stocks for the long term or real estate, of course there are going to be periods when there's a lot of agony and other periods when there's a boom. And I think you just have to learn to live through them. And as Kipling said, treat those 2 imposters just the same. You have to deal with daylight and night. Does that bother you very much? No. Sometimes it's night and sometimes it's daylight. Sometimes it's a boom, sometimes it's a bust. I believe in doing as well as you can and keep going as long as they let you.
It would help if you weren't shocked to learn that the finest investments aren't always the ones we hear about in the newspaper. Although they are out there, the diamonds in the rough require work to find, even though he only comes up with a few contenders each year. Buffett reads hundreds of annual reports to develop ideas. Munger encourages a lifelong pursuit of inquiry in almost everything. You will be able to keep motivated if you continue questioning why you do what you do. Measuring risk, especially reputational risk, should be the first step in every investment review. It's critical to realize that sometimes your investments will work out differently than you had hoped. Avoid setting yourself up for total failure in the first place to protect your wealth. Giving yourself a wide safety margin, avoiding persons with a questionable reputation, and only taking risks when you can be certain you'll be adequately compensated are all positive moves. Even while businesses like Chipotle may have flawlessly bright futures, astute investors may find them too risky if their shares are priced correctly. Just remember that in investing, it's only sometimes sunshine. Number 4. Microsoft, Apple, and Alphabet will remain.
I would expect Microsoft and Apple and Alphabet to be strong 50 years from now. Really strong, still strong.
The well-known investor Charlie Munger, who has partnered with Warren Buffett on investments in numerous industries, commends Apple for its effective management. He acknowledges that the company's leaders are capable of making the right decisions when they are called upon to do so. He believes Apple is one of the strongest corporations and will continue to be such. It's handled impeccably. Munger, a vice president of Omaha, Nebraska-based Berkshire Hathaway, notes that Berkshire has significantly boosted its financial interest in Apple because the company is now so exceptional. The vice president refers to a choice akin to those made with Verizon and Amazon in the past. In 50 years, he anticipated that Microsoft, Apple, and Alphabet would be very successful businesses. But he said that he would never have imagined that his boyhood's venerable department store behemoths would go out of business, or that Kodak or General Motors shareholders would be bankrupt. Number 5. Video games can be so addictive.
This technological change can destroy a lot of people.
Munger praised Activision Blizzard's CEO. He genuinely admires Bobby Kotick, one of the smartest business executives. Berkshire disclosed that it had invested $1 billion in the company that owns Call of Duty and World of Warcraft during the fourth quarter. Munger also said that gaming is here to stay, but lamented the fact that it is too addicting and that a generation of young men is wasting too much time playing video games. He has declared his dislike for violent video games while praising other games as enjoyable pastimes. Number 6. Work from home.
And I think a lot of those people are never going back to 5 days a week. It's amazing the percentage of the people in computer science that don't want to be in the office for a normal life. They want to do a lot of it from locations that are more convenient to them. I think a lot of that's going to remain forever.
It's amazing the percentage of the people in computer science that don't want to be in the office for a normal life. They want to do a lot of it from locations that are more convenient to them. A lot of that's going to remain forever. Many individuals, according to Munger, have become acclimated to not working 5 days a week, and he anticipates that trend to continue. He predicted that business executives would travel less regularly to face-to-face meetings. He pointed out that Berkshire's board of directors has only ever met in person twice a year, and he is pleased that other businesses are saving money and operating more effectively. He claimed that since fewer people commute, traffic would be less congested and time would be saved. Number 7. People will commute less in the future.
And the commutes get harder and harder with more traffic, and it's harder and harder to handle more traffic and more people. It may be a good thing that more people are going to commute less.
Because people can work in the comfort of their homes, there will be less commuting. People do not have to report to work, so there's no reason to commute, and this means less traffic congestion. This is what Charlie Munger sees. The average commute time in the United States is 27.1 minutes, which equates to about an hour per day spent traveling to and from work. The Car Insurance Center estimates that each year, commuters spend around 100 hours traveling and 41 hours in traffic. Some severe commuters must travel larger distances, up to 90 minutes each way. But one of the drawbacks of traveling to and from work is losing time in the commute. Research suggests that daily commutes of more than 30 minutes one way are linked to higher levels of stress and anxiety, and daily commutes of more than 10 miles are linked to health problems. So that's it for today. Thanks to Sir Charlie Munger for imparting us with some useful truths about the issues happening around us and what are the possible things that could happen in the future. What do you think about this topic? Do you agree with me too? Share your thoughts in the comment section below. Don't forget to like, share, and subscribe. I'll see you in the next video.